Hi traders, Chris from the research team here at Pepperstone. Now this week we do get a mountain of different central banks in the G7 space coming to the party, delivering policy outcomes, and everyone's going to be watching what happens there. But of course it's the Fed which will get the lion's share of attention, where they're thoroughly expected to cut rates by 25 basis points. The market's pricing 100% probability of that. We've got the Bank of Canada, where the market's pricing an 87% probability of a cut there, and then the Bank of Japan and the ECB are thoroughly expected to keep rates on hold. Where I think we should be looking, where we could see some volatility in the rates market and swaps, is in Australia, where we've got the Q3 CPI number coming out midweek on Wednesday at 11:30. Now this could really be, depending on the outcome, the make or break situation for a rate cut in November, or potentially, if it's too hot, we could see rate cuts completely coming off the table, and the market speculating that the RBA are done cutting and we may not even see any more cuts with a cash rate at 3.6%. If we have a look at market pricing at the moment and have a look at interest rate swaps, we can see the weight of money at the moment is given a 60% chance for a rate cut in November. They're pricing about 15 basis points of cuts for that meeting. And if they don't cut in that meeting, then they're given an 84% probability that they'll cut in the December meeting. Further out the curve, you can see the terminal implied rate is at 3.15%. So essentially saying, we could get one more cut, maybe two cuts in that cycle, but the cash rate will probably come down to about 3.15. And that's pretty much in line with what we've been seeing in the RBA's guidance, saying that the policy setting at the moment is in a little restrictive setting. And the minutes themselves, if you look at the last policy meeting, it did feel like the RBA sort of backslapping themselves a bit and saying that it almost delivered a soft landing in that situation. And we've seen that in the data. Real GDP is on the up and it's near full potential. So any kind of higher levels than that, and that will feed into higher inflation as demand kicks in. Household consumption is running at 0.9%. In Q3, we expect that to tick up to 2.5%. Nice moves there, and of course that's showing that there's green shoots coming through in the private sector. It's not all public sector demand and spending and fiscal spending which has really been buoyed up, but ultimately we are seeing some positive signs. Now of course it's the labour market which is a little bit of a concern, with the unemployment rate running at 4.5%, but it's still in the eyes of the RBA a situation which is in full employment. So with that weaker labour market read, it really does come down to this CPI print, and after falling pretty heavily in terms of the year-on-year pace, in terms of inflation, both headline and trim mean, we are looking at a situation where the market is saying that the headline rate of inflation could push up to 3% from 2.1%, and that would be right into the top end of the target band. And you can see a situation where the market's saying trim mean will stay around sort of 2.7%, but any higher than that, we'll see a situation where prices are moving up. And again, that would just situation where economics are improving and inflation could be going into the top end of the band, and that would markets would say that's probably them done. So I think the outcome of this could be very, very telling indeed. I think 0.7% quarter on quarter on trim mean would probably deliver a cut in the next meeting, but there's every chance that the RBA could be done. This CPI print is going to be very meaningful for Aussie assets indeed.